Thank you for watching the Housing Oregon YouTube channel. Be sure to join our network and get involved in the work that we are doing. If you can, please like and subscribe. It helps us build this channel, which serves as a platform to communicate with our members. This video is part of our 2025 annual conference. We're looking for folks to be on the conference planning committee. Please email info@housingoregon.org.
The microphone, I'm going to have it right here. Okay, I'll just hold it. Hello, good morning, everybody. Thank you for coming to the Senior Lender Panel. We're going to get started with some introductions. So I'll start with myself. I am your moderator today. My name is Jillian Siraj Felton. I'm the Housing Director at Community Partners for Affordable Housing. And before I was in affordable housing, I was a banker, so I like to refer to myself as a banker in recovery. And I will hand it over to our first banker panelist, Kathy Swift, to introduce herself.
Hi, can you hear me? Is it, okay, great. So I am Kathy Swift. I work at Heritage Bank doing affordable housing and nonprofit finance. And been doing it for 30 plus years, so maybe I got it right now. I don't know. Go ahead.
I'm Gina Leone. I'm the Affordable Housing Director at Columbia Bank. This is the public service announcement. Umpqua Bank just became Columbia Bank on September 1st. We are still working on having that roll off our tongue as well. But so I'm at Columbia Bank, been a banker for 35 years, most of that in affordable housing, and happy to be here with 2 award winners.
I am Ann Rummers. I'm the Deputy Director and Director of Lending at the Network for Oregon Affordable Housing. We are a nonprofit lender. I also am a recovered banker. I was at PNC Bank for 10 years prior to this, so I've been banking adjacent for about 20 years now.
Did any of us want to be bankers when we were little kiddos?
No.
No. So here we are.
I wanted to be a commodities broker.
Wow.
The ship has sailed. Well, let's start with some basics for any other non-lenders in the room. And we'll start with Gina. Can you walk us a little bit through how a bank works and the standard credit analysis process known as what bankers refer to as the 5 C's of credit?
Okay, so for those that didn't grow up wanting to be a banker, here we go. Here's a quick little overview. Many of you probably already know this, but just the basic principle of how a bank works. When you go to your local branch and you make a deposit, that deposit is held, but some of those funds are going to also be used to make loans. Very simple concept, but it is critical to understand that concept as I talk about the 5 C's of credit. If we are holding your deposits and those are then going to be loaned out, we want to make sure those monies can come back. And that gets to the principle of 5 C's. That's all about banks evaluating risk and making sure that their loans can be repaid. So the 5 C's are character, capacity, capital, collateral, and conditions. And I'll go into each of these a little bit further. Character is essentially the very first test where we're looking at the character of the borrower. The simple mechanics of it would be pulling a credit report, a Dun & Bradstreet, a background check, making sure that there's a clear history there. But there's a little bit more to it than that. It's also understanding the reputation of the client in the industry. Are they a leader? Do they have a positive reputation for performing? I'd even go so far as to say, are they communicative? Are they a partner to your bank in sharing information and being very forthright? That's kind of part of the character test. And repayment of debt. So did the terms of the loan documents, were they met during the period that the loan was outstanding? So that's kind of all part of the character test. The second C is capacity. Ann and I were having a fun conversation about this, geeking out on the difference between capacity and capital before the call, or before our presentation today. Capacity is assessing the borrower's ability to repay the loan. So again, we're using some deposits to make loans, so we want to make sure that those loans can be repaid. How does a bank do this? We will ask for a lot of financial information. We're going to ask for a balance sheet, an income statement. Audited financial statements are always preferred. Real estate schedule, contingent liability schedule. We're trying to look at all of that data and understand where is their risk, where is their potential draws on cash flow that could impair that borrower from being able to repay that loan. And there's, all of us kind of do the same thing, but maybe get to it in a different way, various tests that we run, but that's essentially what we're looking for, is how much risk is there within that borrower's financial picture that could impair the repayment of the loan. An example of that might be a lot of contingent debt. A contingent loan is when there's a guarantee on a loan. So if something happens on that loan and whatever the original source of repayment isn't there or is reduced, you might ask your guarantor to step in to help shore up any shortfall. If you have a whole bunch of construction loans and any one of them are challenged, that might impair your ability to repay that loan or other loans. So that's what we're looking at there. One other, this was part of Anna's conversation, one other thing that's kind of part of capacity in our field, I think, is also looking at sources. What are the sources in your budget? And what are the conditions for those sources to be funded? And how will when will those come in? And are they going to come in a format that allows for our loan to be repaid in a time frame that we're expecting? Moving on, capital is the borrower's financial assets and investments. So that's, think about liquidity, think about cash flow from the real estate portfolio. Those are all sources that are available to the borrower to help solve problems. Depending on the size of your loan, we may be looking for different levels of liquidity requirements. So bigger loan, we're going to be looking for more liquidity. If you are asking for a very large loan and you have a very small amount of liquidity, banks will be very uncomfortable with that. The next C is collateral, and this is your real estate. This is what we all love and adore. Banks will get an appraisal to determine the value of that collateral or potential value, and then we'll run tests like a loan-to-value test, making sure that we have a coverage ratio that provides some cushion to ensure that there's sufficient collateral in case we ever had to, and hopefully this never happens, take that collateral to repay our loan. There are federal guidelines that limit how much we can loan on certain types of collateral. So most of us in the room probably work with multifamily properties, and there's a legal lending limit that we can't exceed when we are lending to that type of property. All of this is to ensure, again, that we have sufficient value to cover our loan if there are any issues. The last C is conditions. And this one can cover all sorts of different things. It could be the terms of the loan. We're looking at what's the amortization, what's the loan to value, is this property being over leveraged? An example of that might be, and this was a real example that I saw the other day, a 114 debt cover for conversion, a 40-year amortization, and an interest rate that was probably at least 50 basis points lower than actual rates. That does not work for us in this world. So we're looking at how is this loan being sized in the pro forma, and does that make sense with what we're seeing today with actual rates, actual terms, and can we get comfortable with that in light of all the other C's? We're evaluating all the risks all together. This conditions can also pick up economic environment conditions, which we're all very familiar with: rising interest rates, tariffs, increased construction costs, a pandemic, increased operating costs like insurance expense. So all of those things probably everyone's had exposure to in this room, but we're looking at all of these C's together to evaluate risk and the potential repayment of our loan. Ultimately, the bank wants the loan to be repaid. Sorry, that's a kind of a, it's the facts.
Yeah, yeah.
There we go, that's the 5 C's.
Well, I think we've all been familiar in the last couple years what happens when banks are not being good stewards of deposits is that we end up with bank failures like the Silicon Valley Bank failure, which kind of set off a big ripple through the banking industry and through the affordable housing industry because they were so heavily invested in affordable housing in California. And with that, also the failure of a couple of other very large affordable housing developers. We can really see why some of the credit markets tightened up around that and became more cautious. I wonder if this is for all the panelists. I wonder if you could talk a little bit, digging a little bit deeper into these 5 C's and talk about either what is to you or your banking institution the most important, or what has really risen in importance over the last year or two. And why don't we start with Anne?
I hate being forced to pick one thing, but like Gina said, at the end of the day, it's probably capacity. We want our loan to be repaid. That's the most important thing. I think I want to clarify, I've heard from folks before, not in the lending world, that capacity, you hear capacity and think staff capacity. And so I want to make it clear that yes, ultimately it is capacity from a repayment perspective, but that is an important piece of all of this, and you'll kind of see all these 5 C's tie together, and that is one thing that we're definitely evaluating is your staff's ability to properly manage these transactions. So though the 5 C's don't capacity doesn't specifically mean staffing, it is incredibly important that you're well staffed and have knowledgeable folks to be good stewards so that we can get our loan repaid at the end of the day.
Kathy, what
I would like
for you?
to talk about is conditions. And I'll just put something out there that is embedded in what both Gina and Jillian have been talking about. But this isn't absolutes. It's not a spreadsheet. This is conditional. And the one thing I want to talk about are conditions. So a bank will really adapt its underwriting standards, its risk analysis to the changing environment. So all of the things that you mentioned have led to conservatism. And so what used to work doesn't right now. And until, and that's why I wanted to take on conditions, until we see clarity, you can just expect the bank is going to have a more conservative outlook. Doesn't feel fair, what used to work doesn't now, but that's the reality because we are about protecting our depositors and ensuring that each loan gets repaid, and that the unknowns, so conditions of the economy, of interest rates, of inflation, of, frankly, one of my huge ones right now is what the heck is the federal government going to be doing funding-wise? And how, the other one that's embedded within this is we haven't figured out for our economy yet what the additive impacts are because of the clients that are served in affordable housing. They're going to be hit with food costs. They're going to be hit with reduction of SNAP. They're going to be hit with Medicaid cuts. They're going to be hit with employment weaknesses. You know, all of this feeds into and is part of that conservatism. Is the deal that I will underwrite today the same one that once we get some clarity that I will do in 2 years? No, actually, it's going to be a little more conservative right now for the unknowns, okay? And we also have a pretty good outlook. Conditions are there that so many sponsors are incredibly weak right now. And they and we haven't figured out how are they navigating through this? How are they going to make it to when we get to the new reality? That is another condition. And our industry is so used to working with blinders on at the project level, but that doesn't work anymore. And we have to look at the sponsor level. So those are the conditions that I would put as really important for right now.
I'm going to choose character as the number one for me. All of these are important. As we've all said, we don't ever look at any one of them independently. They're kind of all collectively looked at. But I'm going to choose character because that is really the very first thing that we check. If we are looking at a request and we have a sponsor that is not responsive, doesn't pay interest payments or principal and interest payments on time, if they don't have action plans to try to solve problems, if they're not being communicative or sharing issues that are popping up early, that kind of speaks to character. And we're here, I mean, some of the things we're talking about are very serious and a little bit uncomfortable, but your bank is here to support you, and we're here to support the communities that we're in. And so as part of your being in this community with a bank, your banker wants to be helping to move things along. And while we're not an investor in projects typically, unless it's through a tax credit equity fund, we want to try to help. And so part of that is a reciprocal relationship, and that's comes down to character. Like, know that there's an open door here for conversation if there are problems. 10 years ago, we wouldn't be talking about problems on this panel because it was a totally different world, but this is really what we're seeing today. There's a lot of challenges out there, and so part of that is just being very open with your banker and having conversations. And
I'd add to that, communication, yes, it's key. And over-communicating versus under-communicating. The one thing we don't want is a surprise, right? And the other thing we don't want is that surprise coming when you knew it was going to be happening, but you were hoping for something to save you, and it didn't.
We just turned it into the 6 C's of credit. We added communication. That's
Okay.
Well, I think that's really interesting, Gina. I think a lot of times developers, we look at, the two major financial partners when we are looking at putting a new construction deal together as being our investor and our lender, but they really have very different skin in the game. So the investor has, cash dollars, has equity in it, is a partial owner, but the bank, the lender has other people's deposits in the deal, and that's just a really different risk analysis. It's a different partnership, and I think it's thank you for pointing that out. I think it's worth spending some time on this panel talking about what has been coming up in a lot of panels at this conference and conversations between developers. I think we all have been thinking about struggling portfolios, struggling projects. How do we turn them around? What are some solutions? So I would love if we could just spend a little bit of time talking about that. And when we were discussing this panel beforehand, we noted that some things since the panel we did last year and this year had changed. And one of those was last year it was not an option really to pay down the principal balance, to get some funding, pay down the principal balance on a loan and re-amortize it. Just like on a mortgage, if you make a large principal payment, the payment that you make each month doesn't change. And the reason that that wasn't possible last year is because that flagged that deal for being a troubled asset category, and we wanted to avoid that. But those definitions have changed in the last 12 months. So could you talk a little bit about what it looks like to pay down and re-amortize debt, and why was that not as likely last year as it is this year?
I think this is our TDR. Okay. Okay, so more geeky banker terms to talk about here. So when a project starts to become challenged and we're looking at repayment streams that are different than what was originally underwritten, or we're having to extend loans for an extended period of time beyond what was originally contemplated, banks are going to start looking at these transactions very closely. And the reason that has to happen is because we are federally regulated, and we are required by law, actually through FASB, the accounting standards board, to report on transactions that are challenged. These types of loans used to be called troubled debt restructures, or TDRs, if you've ever heard a banker throw that term around. That term has now been abandoned, and it's now called a financial difficulty modification, or FDM. Bankers love acronyms.
I don't think it's any better. That's my personal opinion.
And so when you have an FDM, your banker may not actually say, your loan is an FDM, but they're having to think about these things because in the background, the banks are having to report more frequently. They're going to have to potentially change the amount of reserves that they're holding because the risk has increased on that loan. The repayment stream that we originally contemplated has been compromised in some way, such that the borrower, or maybe collectively the team, is coming and asking for some kind of a restructure. It's not necessarily a bad thing if it's an FDM, but it will require additional actions inside the bank. So last year, when we started to see increased stress in real estate portfolios, I think it wasn't really certain how long that stress would last. And there were short-term solutions that were available that could kind of you could ride the project out for a while. What we know now is this is a longer-term problem. And so now we're actually venturing into categories where we'd classify these loans as FDMs. Each bank is probably going to look at it a little bit differently. And each loan, depending on the risk of that loan, might contemplate different structures. So there may be a scenario where a reamortization makes sense for a loan because of the risk profile of that loan. There might be other loans where that does not make sense. And there's another format that might make better sense. Usually when you're starting to enter the phase of having these conversations, a bank might also pull in additional resources from another department in the bank, fondly called SAD, or Special Assets Department. Different departments, different banks have different names for it, but SAD. It is sad that we're having to bring these extra folks in. These folks have a very specific purpose in the bank, and that is to have the loan repaid, no loss to the bank, because that is what was originally contemplated in the original loan documents. A SAD officer can be used sometimes for a consult. Like we might just have a conversation with them and say, hey, we've got this loan that's challenged. We're talking about maybe reamortization, or maybe we want to forbear, or maybe we want to do this, that, or the other thing. And they will consult from the perspective of how can we repay this loan. A loan may also be transferred to special assets. I think I might be taking over someone's conversation. Should I pass it to you?
Sorry. Well, but I think we also talk about special assets group, which is SAG, but I don't know if that's any better than SAG.
Yeah, SAG and SAG. Neither one is necessarily a good thing. Maybe should we, because we're in the SAG.
I want to add a little bit something
Yes.
on this. Because the banks are typically, except for just a few, publicly traded institutions who have to report out the problem loans, and who have to report out specifically the FDMs, and it's a line item. Our investors grill us on this. And unfortunately, once you fall into the FDM bucket, the loan is there until it's repaid. So a couple of them, no big, or did you want to add to that? No. So a couple of FDMs, no big deal. Gets to a certain percentage, and then all of a sudden, the investors care a lot. And some of the things that you were talking about, reserves and all, kick in.
Reserves, and then I'll give a couple more examples of what's defined as a financial difficulty, because that might be helpful. This might be, the loan has been, I think last year we talked about risk ratings, but if you have a performing loan, it's risk rated, a certain metric. As the stress increases, the risk rating increases, and the amount of reserves that we have to hold for that loan increases. As you get to a higher risk rated loan, the reserves are higher. That could potentially be qualified as a financial difficulty. If you have past due loan payments more than 30 days, if there's a potential for bankruptcy, if the sponsor is not a going concern any longer, if the future cash flows are insufficient to service debt, or the borrower is unable to find an alternative funding source to take out the loan that is troubled. Those are all kind of examples of financial difficulty. I had one other thing I wanted to say as a follow-up, but it flew out of my head, so I'm going to pass it to you.
Yeah, I'll just sort of go a little bit more into about the special assets group, and I think this is a theme you're probably hearing at the conference, and Kathy already mentioned communicate, communicate, communicate. It's in your best interest to work closely with your relationship manager, to come early, to bring solutions, because when you do reach SAG or SAD or whatever it is for that bank, you're out of luck. They are my father-in-law was a former head of SAG, and he's a lovely person, but his job was to get the loan repaid. So though he's lovely outside of his role, in that role, sort of there, that you've lost your sort of ability, your friendly, your friendly advocate. So again, with the come early, come with a plan, or without a plan, just come to us and talk to us, because once it has reached that special assets group, sort of, as Kathy said, you're not getting out. And it does affect your ability to get more loans from that financial institution and potentially from other financial institutions. So just want to reiterate that key 6th C of credit, communication.
And could you say a little bit more about how that impacts, if you have one deal that's going bad, that's in special assets group with your lending institution, how does that impact my ability to get a loan on a deal that's going to cash flow like gangbusters? Why is one tied to the other?
Yeah.
Or even if you have multiple loans,
Yes.
some of which are doing fine,
Yep.
and then that one.
I'll definitely let Gina and Kathy jump in here, because we don't actually have a special assets group. Our special assets group is Rachel Bidu here in the front. So she is the best. She's lovely. But it does, even at NOAA, it impacts your ability to potentially get, if we're working through a troubled asset, it does impact your ability to potentially get a future loan. That is for sort of all the 5-6 C's that we have run through already. And if you have not demonstrated, again, that character or coming to the table and working with your lender, and they've had to, it's last resort. SAG is last resort. That is just not good. So that means that we have exhausted all options. And I think that in a lot of cases, there are instances when, you've done everything you can, and it's sort of unfortunately a hopeless situation. But in a lot of cases, the borrower isn't. And I think that sort of speaks to the character, and I think also, therefore, the ability to do more lending with that borrower. But I'll let Gina and Kathy sort of add more about how that impacts.
There's a term that we use, willing and capable. Willing and capable sponsor. So that little short tagline, I guess, kind of encompasses all of the C's. Willing and capable sponsor, that you're willing to work with your bank on finding a solution, and that you're capable of bringing resources or solutions to help solve the problem. And we haven't talked a lot about action plans, but I'm going to insert that right here. We love when our sponsors come to us early and say, we've identified a problem. This is what we have established as an action plan to solve that problem. That action plan might not solve the problem immediately. It might be 12 months. It might be 18 months. It might even be longer than that. But if we know that the sponsor is working to solve the problems, and we can see that even though some of the solutions might take 18 months or longer, but there might be some that are shorter, and we can see that you're actively trying to work through those solutions, that goes a long, long way towards building that character test, that you're working as hard as you can to try to get there. That all speaks to the willing and capableness of a sponsor, and that goes a long ways, not only with your direct lender, but also if special assets has been pulled in, that will be very important for them to see too.
Yeah, and I would add, I don't know if, I see some familiar faces from yesterday's session that Tracy Manning moderated on, areas of optimism and what can we be doing. And I was a panelist on that along with an equity, Sarah from Enterprise, and then PHB and OHCS were in on that panel as well. I encourage you, if this is at all speaking to you, get that on the video, because all of these were recorded. That gives you some really concrete ideas for developing an action plan, and an action plan that speaks to all the parties, because it's not just the lender you have to make happy. You have to make your equity investor, if you're in a LIHTC deal, or and you have to get cooperation from other parties. All of that takes a huge amount of time. There's certain steps and efforts. That session really went into the details of that. So please do. And so this is really just a extrapolation of the one small layer of, okay, this is why the bank is the way it is. It's not arbitrary. It's not that one relationship manager. This is how banks operate and what banks need. That helps you, if you know that, when you go into negotiations with us for solutions. So I say the smart negotiator who knows everybody's motivations is the most effective one. So
I'm going to sum up a little bit about what I'm hearing, and that is that for most developers and affordable housing operators, development and asset management are more closely entwined than they ever have been before. And they have to be talking to each other. If you don't know as a developer that you've got a deal, that your asset manager has a deal that's going south with NOAA, and you approach them with no knowledge for a new loan, you're not going to look great. That's going to speak to, oh, what is that capacity? How does this person not know? How do they not know that there's an issue? So I think what I'm hearing is like really communicate with your portfolio managers, with your asset managers, to make sure that you understand your portfolio and you can answer those cash flow questions, and you can, I think the best thing is to answer questions before they're asked. If I know that I have a project, or if we know that we have a project that's underperforming, that's below break even, to have an answer in the can ready to go when you send that REO schedule out, I think that demonstrates that capacity, that character, that communication. We're on top of it. Here's what went wrong. Here's what we're doing to fix it. And then in my experience, I find that I get fewer follow-up questions than if that first question, even just what's going on with that property, and then, oh shoot, I forgot to send that. I'm going to get a lot more follow-up. So I think that's, that these two parts of our organization, which have a tendency to operate independent of each other.
They can't right now.
They can't right now. And the other thing I'm hearing is what I refer to as bespoke solutions for every problem. Like every deal, there's no one fix it. There's no like, well, we're going to get a bunch of grant money and re-amortize every loan, pay them down, re-amortize them, lower the debt service coverage payments, and that's going to fix it. That that might work for deal A, but that may not work for deal B for whatever reason. One thing that came up in our conversations that is a bespoke solution, Kathy, is something that you've been working on with OHCS, which I found really, really intriguing. And I just want a show of hands in the room real quick before we start talking about this. So the solution is to add OAHTCs to existing projects. So if you have an interest rate at 7%, to get an OAHTC allocation to drop that to 3 or 4% and lower your interest rate. The thing about OAHTCs is that all of those savings have to be passed through to the renter, to the tenant. So by show of hands, how many people in here have a real estate portfolio right now, like just in operation? And in that portfolio, do you have projects that have rents that are already significantly below LIHTC max, either because they've been existing for a long time? So I think that there's quite a lot of folks here that it seems like that would be the solution. Can you talk a little bit about what those conversations are with OHCS and what kind of deals might fit? That's a really niche solution. It's a bespoke solution. But speak it to us.
Okay. So let me just say, and I don't know, I haven't seen anybody I'm working with in OHCS on this, but it's not just me, it's a group of us who are really interested in preservation and stabilization. And this really came about from both Housing Oregon and a couple other organizations. And NOAA, Bill Van Vliet, very much a leader on this. We had a working group that during the legislative session was really advocating for a whole bunch of solutions, and we were advocating for funding, didn't get the funding. We know what's going on with the state. But we did get people listening. And so, and then we've also had lots of conversations with PHB. They don't have money, but they have ideas on what they can do and contribute. So with OHCS, one important thing that did change in the legislative session was that there is an allowance now for OAHTCs to not just be passed through in rent reductions, but potentially to be used to pay down term debt and of course re-amortize or refinance, and so that the lower NOI can service that debt or that the pass-through can be in operating, applied to operating, expense. So that there's an accounting there. We're working on those details. Of course, the legislators say you may do this, and then a whole bunch of people, OHCS and lawyers, and then the parties who are really impacted, both sponsors and lenders, and OAHTC investors, who are typically lenders, they have to work out the details, and you have to document it. So we are in that stage, but OHCS is going gangbusters on this to get to that. So we're having the very honest conversations, and they're expecting to make a generalized announcement in October, but have something in place by January. This can be real relief for, again, a subset of deals, and we're going to try and get that in place as soon as possible. Another bespoke solution is something OHCS, for the first time that I've heard, has been open to, and then PHB is very open to, is reducing or changing the regulatory restrictions to up the allowable AMI on existing properties. Again, has to make sense, has to be a real solution, has to be lasting solution. So there's going to be process put around that. But I expect that's going to be something that will be coming into place. That will be really helping existing portfolios where there is a debt service coverage problem.
Thanks. So now we have our bespoke solutions, and I fixed my portfolio, and I got some OHTCs, and I re-amortized some debt, and now I got deals I got to close. So now that we've got our portfolios cash flowing, I'd love us all to get out the crystal ball and take a look at what's coming maybe in 26, 27 on the lending side. I think there's been a lot of talk and buzz about the 25% test, and there's been a lot of speculation on what that's going to mean. I've heard that we're going to, double our deal capacity. Do you foresee sincerely seeing twice as many construction loans, or do you see that this is going to change? Like, what is this going to change in construction lending for affordable housing deals? So that's a question for everybody.
Yeah. Do you want it first, or should I first? You can go first. Okay. This is just my opinion. This is just my opinion, and I don't think it's going to make a huge difference in 2026 in the volume of deals, because we're looking at the whole portfolio. And if you've got troubled properties that you haven't got the plans for, then banks aren't going to really be looking to increase their exposure by 2 more deals. I think that some of the basic issues in the industry, some of the imbalances, need to be addressed first, of fixing portfolios, and then also restoring your cash balances. And then we can see a doubling. So this is excellent news. Do not get me wrong. This is a good thing, and it will, in the longer term, allow for many more good deals to happen, but not in 2026. We got to get some clarity around the other stuff.
Ditto to what Kathy just said. And then also, I think it's going to be not as robust as what we thought, because we'll need gap funding sources to make up that difference, and I don't think there's enough to fulfill all the need. I also sort of feel like there might be a human capacity shortage too to process a huge volume of deals. So collectively, I think there'll be some increase, but it won't be as robust as what we think. If only
Higher subsidy caps, heard. So I'm making a note.
We're not a construction lender, so pass.
Oh, but you are. I believe you have a fund, right?
If the 25% test does mean smaller construction loans, does that mean easier underwriting guidelines for construction loans, lower liquidity requirements, lower capacity requirements? Do those things come together, or what are we gonna see when it comes to how that's going to impact the underwriting of construction loans?
I don't think it's going to change a whole lot, personally, because there is stress in portfolios. Like almost every portfolio we see has stress. And until that's resolved for, we're still going to want to see that there's sufficient financial capacity to solve existing problems and also take on new opportunities. We're hoping that there's going to be some thoughtful restraint, maybe, is a way to describe it, in making sure that developers create their own balance within their organizations to be able to manage both and to sustain that into the future, so that hopefully we don't end up in this situation again, although there's been a lot of things stacked up against us that are totally outside of our control. But I really think that banks will continue to take this 5C, 6C approach when evaluating credits. And I don't see a reduction in liquidity. I just think that that's going to continue to be something that we really want to see, and cash flow too.
I see it in a minor way. So, it's not a one-for-one, right? So what you're saying is absolutely true, and it is also true that if it's a lower construction loan, then I have less risk. So instead of me requiring $2 million of excess liquidity on your balance sheet, it might be $1,500,000. So, it is better. A lower loan is less risk, okay, for the bank, because our highest risk is when you are fully drawn down on your construction loan before the perm lender comes in to take down our construction loan, a small portion of, and your other sources of money, be that PSEF, be that some of the other debt, lift money or TIF money, or and of course LIHTC pay-in. And of course, when you have all of that loan outstanding and you're in the lease up, if you can't make your conditions for the takeout of the construction loan, having a smaller construction loan versus a larger construction loan is helpful from a lender's perspective.
One last thought, and then I'll pass it to Ann. I always like to say that the particular liquidity should be commensurate with the size of the loan. So we will still, as I said, apply the same tests, but will we change that philosophy that the liquidity should be commensurate to the size of the loan because we have this 25% test? No, we're still going to test that it's appropriate for the size of the actual loan. Yeah.
Yeah, and I'll also add, sorry, I'm thinking, that once we get the 4% deals to be leased up in the time that they said they would, at the rents that they said they would, then then a whole lot of the cushion that the lenders are looking for is going to fall away. Right now, I had conversations with bond counsel a few months ago, and they were saying, of all of the 4% deals that have been booked in the last couple of years, you know, with the great expansion that we did, new construction with the 4%, he could only put 2 fingers up of 40-some deals that actually leased up within the time frame, and had the debt level, the perm debt level, that was pro forma'd at the beginning. Luckily, one of my deals was one of those. Okay, I'm a little proud, but little brag. That's huge. That is beyond huge. So we need to get back there, and then that will be when I think the 25% test will really allow us to expand the level.
So I'm going to go a little off script here and just ask the question I think plagues a lot of us as developers is the way that we're going to build up our liquidity is to close that next deal and get that developer fee installment. We have chewed through during COVID a lot of our deals. We had to sacrifice our cash developer fee to make the deal close. We had delays in lease-up, delays in construction, problems with supply chain, and that the liquidity we were counting on for those deals between, let's say, 21 and 24, that we're going to replenish our liquidity, didn't. So now we're looking to the 25, 26, 27 deals, but how do we get those closed? How do we get there when this is where we are? What, when we come to you and say, we got to get this deal, we want to close in the spring, we have an OHCS award, we're ready to go. What do you want us to demonstrate? Like, if we can't demonstrate that our portfolio is fully cash flowing today, what do you want to see from us that's going to make us a good bet?
I'll start and then hand it off. We might look at things a little bit differently than the banks, but we do recognize that fee is crucial to organizations' continued success. So we're very aware of that as we're doing our underwriting. I think it's really important, getting back to everything we've already said, showing that improvement, that you are taking the steps. Maybe that doesn't mean that there is more cash in the bank for you right now, but you are taking the steps to improve that portfolio. So it's coming to us again and, on the whole portfolio demonstrating that you're aware of the issues and you're doing what you can, and that this cash infusion will help you continue to support that portfolio, and that's a key piece of this. So that's, I think, just that demonstrated an improvement and knowledge and understanding of your portfolio. And I at some point I do want to go off script a little bit too, so hopefully we'll have a chance for that.
I think we have time.
I'm thinking about one add-on to that in terms of data about the portfolio. Sometimes we'll ask for a developer fee receivable schedule. So the composition of the real estate schedule will include performing properties and now, unfortunately, some non-performing properties. Sometimes it can be helpful to share information about this is what we are planning on receiving for this year, for developer fee income. And we can see that in your income statement as a recurring source of income, but illustrate that to us. Show us this is what we can see is going to be coming in for these performing properties that have historically performed. That could be a little nugget of information that could be helpful. We may not necessarily underwrite to it, but it's a helpful piece of information to tell your story. That there are properties that are kicking off cash through the cash flow waterfall that will benefit the operations of the company.
I mean, that's a standard due diligence item for us these days, is to ask for that developer fee schedule. It's not on our checklist, but all of our relationship managers are asking for that, so that is a great point.
That would be something, to Jillian's point, like, just have it in your back pocket. Be proactive and say, here, banker, like, I've already prepared this for you. This might be a helpful piece of information. Your banker will love that. Yeah.
And if in your answer you have several of these deferred fees that you actually can't realistically project. We'll be providing cash in the next couple of years. That tells me something too. And so really knowing your facts on this will be very helpful and is essential. Oh, one other thing I'd want to add is that on the deferred developer fees, or even on the developer fees, I would suggest that as an industry, we need to switch a little bit, or at least in the next few years, next couple years, you should be adjusting your ongoing operating expense run rate so that you aren't depending on those deferred developer fees. Use the developer fee and the pay-ins of the deferred developer fee to refresh your liquidity balances. That's going to be a really important thing, and it's going to take, we know you can't access capital markets to get more cash in. You can't raise, you won't have stock. There's only so much grant money that you can get to reestablish your operating reserves. So the developer fees are, I think, going to be a meaningful source.
I have one last thought on this, at least from my perspective. I'm thinking about a conversation I had with a customer several years ago. And the question that I posed to them was, how do you see your business growing over the next 5 years or 10 years? And we had that conversation. And they asked me the question, what do I need to see to help them get there? That was a really good conversation. And the first thing that I told this client was, we need to see increased liquidity balances. No one wants to hear that, right? And it can't happen on a dime. But this client said, how much do you need to see for me to grow my exposure with you to this amount? And I gave him a number. And over a period of time, they did it. They increased their liquidity. They saved some of that developer fee to grow their liquidity to keep it on balance sheet. And that is a fabulous story to tell a credit officer. That we had this proactive conversation because they were being very open with me and I was being very open with them, and they listened. And now we can see this growth in this income. And that established, that going back to that character test, that meant everything. And that there's a continued growth in that relationship to this day.
Did you want to go off script? Because we've got about 15 minutes, so we got a little kind of some.
Talk about underwriting first, and then
Yeah, let's talk about where are we seeing underwriting going in 2026 and beyond?
I'll jump in first. I think we're already there. Our underwriting is shifting, or has shifted. So I think what you're seeing today is where it's headed for 2026.
Oh, come on, give me numbers.
Least rates.
Where are we? I mean, where
Rates are coming down, so that's great.
where do we want to see our debt service covers? Where do we want to see our liquidity?
Yeah.
Give it to me. Give me numbers so that we can plug those into our pro formas and our models and take action after this meeting.
So NOAA is always standard 120 DSCR, stabilized 110 for the life of the loan. Metro area, it's going to be real rough to support anything less than an 8,500 a unit in expenses. 6 months of operating reserves. We're not doing anything. I don't think anybody's doing anything less than 6. That's just not justifiable these days.
7% vacancy.
7% vacancy, yes, thank you. Some cases more if you have studios. We're definitely always a 10% discount to market on rents, and sometimes greater. If market, we're cutting studios far below market. So definitely paying attention to what's actually achievable rents, not just what will work in your pro forma, because we're going to come in and cut those when the appraisal comes in.
Can we just pause there? I want you to say more about the discount to market rent. I don't think that that's something in Oregon that we've seen a lot of here, and a lot of other jurisdictions where 60% rents are really close to market rate rents. That delta is how it's underwritten. But that's kind of new to us here. Could you say more about how you determine what the market rent is and how much you're discounting it?
Yeah, so we'll be looking at the appraisal to confirm. We'll be looking at comps. We're going to be looking at your portfolio of local operating properties. We're looking at our own portfolio. And again, at a minimum, we're going to want to see a 10% discount. So that's the market rate rents. But a lot of times, the AMI, we're not hitting max tax credit rents. And so we're having to significantly discount below max tax credit rents. So not underwriting max tax credit rents, at least in the metro area. So there's a lot of, we factor, we look at a lot of different data to help us make those decisions, real live data on what's actually achievable in the market. And I'll let Cassie
So
and Gina.
I'm just going to put some numbers to that real quick, just some made-up numbers. So right now, just for all us developers in the room, a 60% studio rent in the metro area, max tax credit rent would be about $1,300. And what I hear Ann saying is that if the market rate rent in that neighborhood, that jurisdiction, is about $1,000, they are going to underwrite that unit's rent at $900 or $800. So the fact that it's a 60% unit and can be rented for $1,300, the bank is going to underwrite it at $900 or $800. And so that's just something to keep in mind when talking to OHCS, when talking to PHB, when talking to other funders about why you have a 60% unit, but your pro forma has the rent so much below tax credit, is because that's what Ann is going to underwrite it at.
And we're underwriting a 10%.
And that's just new for us,
Right.
like
Yeah.
as a state, as a metro area. And so I just think it's really important to, I'm sorry to drill down and get a little wonky here, but it's new. And I think I get pushback from funders if I mark something a 60% unit or a 50% unit, and then the rent is closer to 40, and they're saying, well, you can get a lot more leverage. I don't want to give you more subsidy because you can get more leverage, but actually we can't.
Yep.
And so this is a really good communication conversation starter with our jurisdictional funders about what's really possible when it comes to leverage.
And let me just say on the market piece, we're underwriting a discount to the market rate rents. And part of that is that we're seeing, and I think you all are seeing it in the portfolio, in your own portfolio, folks are going across the street to the market rate property because it's $50 more or the same price, and they don't have to do the tax credit compliance work, or it's, brand new, beautiful property with more amenities. So that's the logic behind the 10% discount to market, is we've got to be able to attract our tenants to our property, and that's how we do that. And honestly, 10% is probably not enough right now. And so you might see more, we might go higher than 10% discount to market, so.
I think one of the questions was, where do we get the rents? So we will look at if we have an existing appraisal for, maybe it's another project but same market, we might go pull some market data from there. This is if you're in like pre-flight underwriting or term sheet phase initially to set rents. If you've got a deal signed up, you've ordered an actual appraisal for that property, we would be looking for a lot of data coming from that, and maybe even doing calls, doing our own due diligence online and seeing what we can find out. Novogradac also has a really great website where you can pull rents by county and bedroom type and AMI type, and then they also list the FMR on that same kind of disclosure, so that can be super
CoStar
helpful.
as well.
And CoStar as well. One other thing I wanted to say was about vacancy. Depending on the product type, we might stress, like if you have PSH units within a project, we may stress the vacancy on those units a little bit higher than the rest of the project. So I wanted to add that on top of all the good stuff that has been shared. Oops,
Yeah.
there you go.
Agreed.
This is my off-script moment, because we only have like 7 minutes.
Yeah, and then I think if we have some time for some audience questions, I'll get up and, which is good for me because I don't
This
like
is just
sitting down.
one idea, or I've been hearing folks doing, and I just wanted to share with you all, as Jillian was talking about asset management and the development departments maybe not working together. I've been hearing of organizations putting together sort of their own internal committee and having their own troubled asset list, and they all meet, asset management and development meet. They talk through the issues that are happening so everybody's informed, because I think a lot of these restructures are falling on asset management. They maybe, don't have the capacity, so development has a lot of the expertise and it needs to get pulled into that, and so that's helpful with those restructuring conversations and making those plans that we've been talking about. So I highly encourage, put together your own troubled asset list. Reach out. We've had folks reaching out to us saying, hey, what deals are on your troubled asset list in our portfolio? What are they rated? Like, how should we be looking at these? So your lender will absolutely share all of that information with you, but I think that's a really great way to make sure that everybody's talking.
Question?
So going back to OAHTCs, for those of you who do those deals, and thinking through underwriting, and thinking about new projects, not preservation. We know that there's a required amount of pass-through for OAHTCs, but we know hitting that exact number, and especially hitting that exact number over time, is not really likely. How do you underwrite projects with OAHTCs in the pass-through, and what do you like to see in terms of cushion there?
No cushion. OHCS is telling us no cushion. We are underwriting to that exact number. That is the guidance that we've, Yep.
You don't see any risk in that?
This is what, we're following the guidance that we're getting from OHCS, and so that's what they're expecting to see, and so that's therefore what we're expecting to see. I have, thoughts that I won't get into, but that's sort of generally what we've been doing more recently.
Can I have a follow-up to
Sure.
that? And if we were advocating for maybe a little bit different lens on that, what, from the way you see that properties operate over time, particularly with OAHTCs, what should we be advocating for to ensure that properties are set up for long-term success?
That's a good question.
Travis, you got to get involved in Housing Oregon and our working group on preservation and stabilization. And I think that there can be movement on that, but it takes a legislative thing. So that is, that's where we got to go. Let's get this first one done and then build on there. But I agree with you.
Do we have anybody from OHCS in the room that wants to speak on this?
If we do, they're being real quiet. Well, we have another question here.
Hi, I'm Pooja and I work for SEI and we are an emerging developer. So the thing about the 10% below market rate for studio units is really concerning because it's kind of like opposing with OHCS, what OHCS wants us to do, which is build more units, right? So as developers, we are trying to get maximum leverage for our projects and putting more studios in it, when in fact a studio is more affordable in market rate housing. So my question to this group here is there like some joint advocacy over, let's not focus on the units, but like on bedroom sizes or other things for subsidy, because it's literally like putting ourselves at risk by making more studios in affordable housing.
Yeah, we, especially on a, deal by deal basis, are trying to call attention to this issue, and I think OHCS is listening, I think, and so I don't know that there's going to be a shift today, but I do know that they're understanding. I mean, we're trying to set these projects up for success. We're not, our goal is not to kill a project. We want to see it operate because of all the issues that we're seeing today. And so we're trying to be smart about what we want you to be able to lease up your project and not have to put millions of dollars in when it comes to conversion, right? That's ultimately what we're trying to do. And maybe that is that OHCS needs to be putting in more money at the underwriting stage because these projects aren't penciling. But they are hearing us, and I think folks are starting to understand more in depth about the issues and the root cause and sort of how we can solve for them. Unfortunately, we're not there yet, but I think there's, OHCS has done their study of their portfolio and they understand that, and so now I think it is really, again, sort of those asset management and development all need to be talking and inform each other, and we are having a lot of conversations are being had, and I think that is really positive, and there might be momentum towards that. So.
Yeah, and I think it's a real catch-22, right? Because we want more units, we want more grand openings, we want more ribbon cuttings, and at the same time, more units do us absolutely no good if people can't afford to live in them.
We want your organizations to be viable, right?
Mm-hmm.
We don't want you putting in all that cash. Like, we want you to be able to build more units. If that means we're cutting units by 10 units on this project so you can do 150 more tomorrow, then, I mean, that to me is, I'm.
Also, I do believe that this is a temporary aberration of market and affordable. It's just an imbalance. Everybody, affordable and market rate, the units that were getting built were heavily weighted because of construction cost increases, et cetera, and all those factors. We just built too many across the whole portfolio.
We'll shift.
We'll
We'll shift. Things will
It'll come
improve. It'll
back
take
again.
time.
Move us on, because I know we have at least two more questions.
Hi. So with the discussion of distressed assets and working out for the banks, you're presumably in the deals with CRA credit. Does the benefit to you of CRA credit also turn into different processes that are more friendly to the nonprofit in the distressed community?
No. Sorry. Well, okay.
I'm going to say no, but yes.
No, but
Yes, and
yes.
that the bank will possibly be slightly more patient,
Yes.
but the outcome is still going to be this, they're going to have the same desired outcome.
Even in the CRA, it has to be a good loan that we expect repayment of entirely. So, yeah.
Hi, I was just, I have two questions, one more wonky than the other, but on the underwriting criteria, and specifically, are you looking to underwrite deals at a different year-over-year 2%? We historically have used 2% increase on income and 3% on operating expenses for us developers in the room. Should we be shifting that? And then two, the more wonky, back on the 25% test, assuming that borrowers meet the 5 Cs, it feels like one of the impacts that I haven't heard a lot of people talk about is if we could have a taxable tail on that construction loan, but really that just creates a more expensive project. And I guess I'm asking for confirmation if I'm thinking about that accurately.
Do you want to take 25% test first? I'll do trending. Okay. The trending, we're still trending at 2.3, and honestly, we're finding ways to. We all need to shift as an industry, like, right? One bank doesn't want to do it because then you guys aren't going to come to us to do the lending, right? So admittedly, we're finding other ways to make up for how we should actually be trending, which is more like a 3.5. So no, we're still trending at a 2.3. I don't know if there will be a market shift. I don't imagine there will be. It would be lovely if there was a market shift, but we would need to do it as sort of a whole.
OHCS has to do it, and all of the other states have to do it.
Should we just all agree here? Like, we've already agreed it's going to be 6 Cs now. Let's just do, okay, let's just increase the other thing too. I agree.
And two, all of the things that she said in the stress testing are really just mathematical ways to get at the 2 and 3% don't work, okay? So you don't want to do 3 and 5 and everything she said. It's a either or, we get to the same place.
I would also recommend on the developer side and / consultant side, if you are not already doing this, do a 15-year pro forma and look at what the results are in year 15 using a 2 and a 3. And then stress it to what we're actually seeing it today. Do it at 3 and 5 or whatever, and then see what the result is in year 15. And can you say, okay, I'm comfortable with that? Maybe yes, maybe no, and we do that.
Yeah, we do that, and we make sure, will that operating reserve cover, whatever those deficits are over the course of those 15 years? And if so, that's fantastic. So that's definitely something that we're looking at. I mean, we do those stress tests on our own, even though we aren't underwriting the 3-5 because we do want your business. We are doing those stress tests and making sure that all those other mitigants are in place.
I think we have time for
Can you
just
answer your 25% test question?
one more question.
I wanted to ask about bad debt and AR, since that's something that's not typically contemplated at initial underwriting. Yeah, sorry.
No,
Can you hear me? Okay. So this has become an increasing issue as we approach conversions, particularly in the metropolitan area. And so I'm just curious, like I know you mentioned, and that you're raising the benchmark in terms of vacancy from typically 5 to 7. I know that also can vary depending on like tenant population, if you have a split population between PSH and non-PSH, for instance. And so I'm curious if that increase is to account for AR and bad debt, or if you're going to be treating bad debt separately, right? So if you have a 7% physical vacancy, you could potentially have 3% or more in bad debt or AR, so then your overall vacancy is looking like 10%, and then combining that with a discount on the studio rents is, again, like creating somewhat of an unconvertible situation.
Yeah. You're going to hate my answer because my staff always hates this answer. It's really on a case-by-case basis. We definitely have included additional bad debt, generally speaking. We're hoping that the 7% is including that, but there have been cases where we are adding in additional bad debt expense. And then if we're seeing if the appraisal, for example, has sort of support for something more than the 7%, then we might be underwriting it. So it's not I don't have a blanket answer to that, always on a case-by-case basis, but maybe the other lenders have different.
I also think it's interesting to track actual for both, because what we're seeing is there are some projects where you're going to writing off all that bad debt, but maybe you're choosing to write it off 2023 bad debt in 2024, and that tanks the debt service cover, and then credit's like, what? What happened to this project this year? And it's like, well, really, because we've got that detailed out, we can tell that story that there's bad debt that's been happening 23, 24. We're not seeing that in 25, so we're seeing improvement in the action plan. So there's a story to be told by measuring, I think, both separately.
And I will say that an example, I can't stop. We have the projects that are coming to us that are having a hard time converting. In their income statement, there's a lot of bad debt, and so we're seeing this, and we unfortunately, even when it's coming to funding, we're having to underwrite that. So I think that's a perfect example of maybe we didn't include it, at the front end underwriting, but it's getting to funding, and it's like, well, we can't ignore this reality. Right. Yeah.
And I would add that I again think this is a little bit of a time of anomaly, because before the rent assistance was there to bail out. So you had accumulating accounts receivable that then got paid down and through rent assistance as they go through the eviction process, right? That is hitting the wall right now, but once tenants and sponsors realize that and revise their eviction process, et cetera, that won't be ongoing for the next 15 years. I think it's it's an anomaly of time.
And in the metro area, it's primarily studios and ones where this is happening, not on twos and threes.
I think we are past
Way over
time. So thank you all for hanging out with us, and thank you to the panel for answering all our tough questions. Let's go get some lunch.
Yes, I like the good questions. Yeah.
The what? Yeah. On the past.
Hi, Andrea. Thanks for the
Hi, thank you.
So, am I thinking about that right? The taxable tail? Yeah, we're
Yeah.
probably going to see more taxable tails, I think.
Yes.
Yeah.
I think it depends. It's going to depend on what OHCS limits our PAB amount to. Because right now, like we were constrained by the amount of PABs we had. Our current constraint is gap funding.
Right.
Like if you look at the 26 pipeline, the constraint is gap funding, not PAB availability. So right now, my understanding from OHCS is right now their intent is to allow the whole loan to be PAB. Like, so if you need a 40% construction loan, you need 4% of it, they're going to allow it. It's, right. But I think 27, 28, when we start seeing a lot, I think we're going to start seeing a lot more preservation deals